Promotional versus preventative trading bias, part 1. So let's start by looking at what preventative or promotional biases actually are and what this could mean in the context of your trading. Generally speaking, these are generally termed optimism or pessimism biases in the literature and generally refer to a disposition either way, producing very opposite behavior and different outcomes. They can develop over time outside of a trading context and then taken into a trading context where there's often an intensity and a complexity that exacerbates these. There's been a suggestion that all traders might have a natural tendency that deviates from a central point, so they have a tendency to promotion or prevention, but the degree obviously differs depending on the individual trader. And of course, the goal with any bias is to become aware that you've got one and then put things in place to correct any mismatch. So in this session, we're going to look at promotional bias, and in the next, we're going to look at preventative bias. And your challenge is to see which one resonates with you. Now, it's not all bad news, of course. There are qualities associated with promotional bias, and there are challenges. In terms of qualities, traders in this place realize not all options will succeed, but are sure that all will not fail too, and this puts them in a relatively confident place. They're often ready to learn from mistakes and improve over time with hands-on experience rather than trying to learn the rules of the game. They're less prone to giving up, more resilient generally if they have a setback, and they tend to trade entry signals when shown and let profits run. They're also more likely to cast the trading net wider regarding potential opportunities and looking at different instruments, for example. However, there are challenges with this. They tend to have late exits regarding fear of missing out and ultimately may see larger profits given back to the market, talking themselves to stay in trades that they really shouldn't be. They may be prone to over-positioning or over-trading, meaning on a sudden market turn, there may be a larger loss than perhaps should be the case. So in this case, actually setting the maximum number of trades is absolutely critical. They tend to enter sometimes prior to signal confirmation, have that itchy trigger finger syndrome, and are subject to minimalization bias, i.e. taking action before you've got full information. They're likely to be less thorough in analysis and revising plan on the basis of harder evidence, so more likely to revise based on a whim, and may also be prone to bottom fishing the market, or attempting to. They may scale their positions too early, so ramp up the extent to which they're trading without evidence of reliability, and will tend to look for opinions which only agree with theirs in longer term trading ideas. And of course, they may be unjustifiably overconfident. So if you have these challenges and yet see some of the qualities, it could be a promotional bias that you're having to deal with in your trading.